macro currency signals.
If you follow the silver market closely, you can feel when something changes. Not a small fluctuation, not a routine bounce, a shift, a structural tremor that moves beneath the surface before it explodes into public view. What we are witnessing right now is not just a price rally. It is a signal, a warning, a recalibration of value that has been building for years. The title says that vaults are empty and demand is exploding. That is not a dramatic exaggeration designed to grab attention. It is a reflection of tightening supply chains, rising industrial necessity, and a growing distrust of paper promises. Silver is not just rising because traders are excited. It is rising because the foundation underneath the global financial system is straining under pressure. Before we move forward, if this viewpoint resonates with you, take a second to subscribe and turn on notifications. Leave a comment below and tell me where you're watching from, and what time it is where you are. Now, let's return to what's quietly shifting beneath the surface. The world has entered a period where stability is questioned daily. Trade structures are shifting, legal frameworks are being tested, economic growth is slowing, while costs continue to rise. This combination creates a specific type of environment. An environment where tangible assets begin to outshine paper assets, where trust in systems weakens and trust in metals strengthens. Silver sits at the center of this transformation. Unlike many assets that depend entirely on confidence, silver holds dual power. It is both monetary and industrial. It functions as a store of value when currencies wobble, and it functions as a critical component when industries expand. This dual identity makes silver uniquely explosive during periods of stress combined with technological growth. Right now, both forces are active. On one side, inflation pressures refuse to disappear. Even when official numbers fluctuate, input costs across manufacturing, transportation, and energy remain elevated. Tariffs and trade frictions add layers of complexity and cost to supply chains. Every additional friction point increases uncertainty, and uncertainty fuels hard assets. On the other side, industrial demand is accelerating. Electrification, renewable energy infrastructure, advanced electronics, medical technologies, defense systems, and high-performance computing all require silver. Not optionally, necessarily. There is no scalable substitute that matches silver's conductivity, reflectivity, and efficiency at the same level. When you combine monetary fear with industrial necessity, you create a pressure chamber, and pressure chambers eventually release. For years, silver lagged behind gold in terms of attention. Gold captured headlines as a central bank reserve asset. Silver quietly supplied the physical backbone of modern technology. But when volatility rises and capital searches for undervalued assets with asymmetric potential, silver suddenly becomes impossible to ignore. The recent surge in price is not random. It is the market repricing risk. Risk of inflation that lingers longer than policymakers admit. Risk of slowing growth combined with rising costs. Risk of escalating trade disputes that fracture global supply chains. Risk of currency debasement through sustained fiscal deficits. Silver absorbs these risks differently than other assets. It does not promise dividends. It does not rely on quarterly earnings. It does not depend on political approval. It simply exists. Finite. Extracted through labor and energy. Embedded into infrastructure and stored as wealth. Now let us talk about supply. Mining output has not kept pace with projected demand growth. Many silver mines are not primary silver mines. They are byproducts of other metal production. That means silver supply depends heavily on the economics of copper, lead, zinc, and gold mining. If those sectors slow or capital expenditures decline, silver output tightens indirectly. New mining projects take years to permit, finance, and build. Environmental restrictions, regulatory uncertainty, and capital discipline among producers have limited aggressive expansion. Exploration budgets were cut during prior downturns, leaving fewer large discoveries in development today. At the same time, above-ground inventories have been steadily drawn down. Exchange inventories fluctuate, but what matters is accessible metal. When industrial users begin locking in long-term contracts, that silver becomes less available for open market trading. When investors demand physical delivery rather than paper exposure, stress increases within the system. The difference between paper silver and physical silver becomes critical in moments like this. Most daily price discovery occurs in futures markets and exchange-traded products. These instruments allow exposure without requiring physical delivery. Under normal conditions, this structure functions smoothly because the majority of participants settle financially rather than requesting metal. But during periods of heightened uncertainty, behavior changes. When trust in financial intermediaries weakens, more participants prefer direct ownership. They want bars, coins, allocated storage. They want to eliminate counterparty risk. As more contracts convert into delivery requests, inventory pressure intensifies. This is where the phrase "vault's empty" begins to move from metaphor to measurable reality. It does not mean zero silver exists. It means available silver relative to demand shrinks rapidly. It means replacement costs rise. It means premiums widen. It means lead times extend. It means strain. And strain in commodity markets rarely resolves quietly. Silver's volatility is not a weakness. It is a feature. Historically, silver moves slowly during complacency and violently during disruption. When volatility returns to global markets, silver amplifies it. We are not in a calm era. Economic data signals deceleration in growth. Fiscal deficits remain large. Monetary policy operates within narrower flexibility than in past cycles. Governments face increasing pressure to stimulate without reigniting inflation. That is a difficult balance. When growth slows and policy options narrow, confidence erodes. Gold responds first to monetary uncertainty. Silver follows with acceleration. The gold-to-silver ratio compresses during strong silver phases, reflecting outperformance. That compression often signals a broader repricing of hard assets. Price targets discussed across the market suggest gold testing higher psychological thresholds and silver pushing into ranges that have previously acted as resistance. But price levels are only surface markers. The deeper story lies in behavior. If silver holds higher lows during pullbacks, if industrial demand remains firm despite elevated prices, and if physical premiums refuse to collapse, then the structural trend remains intact. One of the most misunderstood arguments against silver rallies is the claim that high prices destroy demand. That logic applies partially to speculative investment demand. It does not apply as easily to industrial necessity. Solar panel manufacturers cannot simply remove silver from photovoltaic cells without efficiency losses. Advanced electronics require silver for reliable conductivity. Medical devices rely on its antimicrobial properties. Defense systems demand high-performance materials without compromise. In inflationary environments, essential inputs maintain demand. Costs are passed through supply chains rather than eliminated. This creates a situation where silver demand remains resilient even as price rises. Meanwhile, investors who previously ignored silver begin reevaluating it. Hedge funds increase commodity exposure as diversification. Asset managers rebalance toward tangible assets as protection. Retail buyers return to coin shops when headlines reflect instability. This layered demand compounds. Another factor often overlooked is geopolitical fragmentation. As nations prioritize domestic production and strategic autonomy, stockpiling critical materials becomes rational policy. Silver's role in electronics and energy transition technologies makes it strategically significant. When multiple actors simultaneously seek to secure supply, availability tightens faster than models predict. Volatility then feeds itself. Sharp upward moves attract momentum traders. Pullbacks attract long-term accumulators. Media attention amplifies awareness. Each wave brings new participants. But disciplined strategy remains essential. Not every spike should be chased. Sustainable trends build through consolidation. Pullbacks test conviction. Strong trends survive those tests. The key question is not whether silver will fluctuate. It will. The key question is whether the structural drivers remain intact. Inflation risk persists. Industrial demand expands. Supply growth lags. Geopolitical tension increases. Fiscal pressure mounts. These drivers have not disappeared. If anything, they are intensifying. Silver's breakout above key resistance levels reflects more than technical momentum. It reflects shifting perception. It reflects capital rotating toward assets perceived as scarce and durable. The mining sector responds with rising equity prices and renewed investor interest. Exchange-traded funds experience inflows during periods of strength. Physical dealers report increased activity when volatility spikes. These are interconnected signals. The long-term outlook remains constructive under conditions of economic uncertainty. When currencies face pressure and trust in centralized systems wavers, metals historically outperform. Silver, because of its smaller market size relative to gold, moves faster when capital flows increase. That leverage works in both directions. But during emerging bull phases, upside volatility can be dramatic. Patience and discipline remain essential. Silver is not merely reacting to headlines, it is reacting to structural imbalances that have been developing quietly. Trade disruptions, legal uncertainties, rising costs, and strategic stockpiling are converging. The narrative is not about a single day's price spike. It is about a world adjusting to a new financial and industrial reality, and silver is responding accordingly. When a market transitions from complacency to urgency, behavior changes rapidly. You can see it in trading volumes, you can see it in inventory withdrawals, you can see it in widening spreads between paper contracts and physical delivery. But most importantly, you can feel it in sentiment. Sentiment is the invisible force that determines how aggressively capital moves. For years, silver was treated as secondary. It was overshadowed, underestimated, and frequently dismissed as too volatile to serve as serious protection. That perception is reversing. Volatility is no longer viewed purely as risk. It is being recognized as opportunity. In an environment where traditional assets face compression from rising rates, slowing growth, and margin pressure, silver offers asymmetry. The downside is defined by production cost floors and industrial necessity. The upside is amplified by supply constraints and monetary instability. Let us examine the supply chain more deeply. Silver extraction depends heavily on multi-metal mining operations. When base metal demand slows due to economic deceleration, output of byproduct silver declines. That reduction is not immediate, but it becomes visible over quarters. Simultaneously, capital discipline across the mining sector limits aggressive expansion. Investors previously punished over-leveraged producers during downturns. Management teams learned caution. New projects require clear profitability before funding. Exploration timelines stretch across years. Permitting delays extend even further. Environmental standards tighten. Political risk complicates cross-border operations. These factors compress future supply growth. On the demand side, structural trends accelerate. Renewable energy infrastructure continues expanding. Solar installations require silver paste for photovoltaic conductivity. Electrification of transport increases component density in vehicles. Grid modernization demands advanced circuitry. High-performance computing and artificial intelligence hardware rely on efficient conductive materials. Silver's physical properties remain unmatched in conductivity and reflectivity. Attempts to substitute often reduce efficiency or increase complexity. When industrial transformation coincides with monetary uncertainty, demand becomes layered and resilient. There is also the question of currency dynamics. Persistent fiscal deficits require financing. Financing often expands monetary supply. Even when central banks attempt restraint, debt burdens constrain flexibility. Markets recognize this tension. When currencies gradually lose purchasing power, tangible assets attract capital seeking preservation. Silver benefits not only from inflation expectations, but from erosion of trust. Trust once lost is difficult to restore. Another element driving this environment is the transformation of global trade relationships. As nations reconsider dependencies, supply chain resilience becomes priority. Strategic materials receive attention. Silver may not always be labeled strategic in headlines, but its role in energy transition and advanced electronics elevates its importance. Stockpiling behavior does not require public announcements. It can occur quietly through procurement strategies. Quiet accumulation tightens availability. Exchange inventories offer partial visibility, but they do not capture private holdings or long-term industrial contracts. When visible inventories decline while demand indicators rise, markets adjust abruptly. This abrupt adjustment appears as explosive price movement. Short sellers covering positions amplify upward spikes. Algorithmic systems trigger buy signals when resistance levels break. Momentum funds enter on trend confirmation. Each layer accelerates velocity. However, strong trends also require foundation. Foundation exists in sustained physical demand and constrained supply growth. The gold to silver ratio often provides context. During periods of intense monetary fear, gold leads. When industrial acceleration joins monetary fear, silver compresses the ratio by outperforming. This dynamic suggests broad participation rather than isolated hedging. Investment flows into mining equities reflect leverage to metal prices. When silver strengthens, producers with operational exposure experience magnified earnings potential. Exchange-traded products tracking physical metal absorb additional inflows. Yet none of these mechanisms create silver from nothing. Production cannot surge overnight. Recycling increases at higher prices, but remains limited relative to industrial expansion. The idea that price alone solves shortages overlooks time. Time is the variable most investors underestimate. When demand accelerates faster than supply response, price discovery must compensate. Higher prices ration demand, incentivize exploration, and signal scarcity. Scarcity signals powerfully. There is also the psychological component of breakout levels. Markets remember previous peaks. When those peaks are surpassed, narrative shifts. Participants who once viewed resistance as ceiling begin seeing it as floor. Confidence builds incrementally. Pullbacks occur. They test conviction. But if pullbacks hold above prior breakout levels, trend structure strengthens. Daily price targets circulating within the market suggest ranges that reflect near-term optimism. However, longer-term trajectories depend on sustained drivers rather than single events. Economic uncertainty remains persistent. Growth shows signs of deceleration. Fiscal expansion continues. Trade friction lingers. Policy clarity fluctuates. Under these conditions, hard assets historically outperform. Silver's smaller market size relative to other asset classes means incremental capital flows create outsized impact. When institutional allocation shifts even slightly toward commodities, silver absorbs significant effect. This asymmetry explains explosive sessions, but sustainability requires discipline from participants. Investors must separate structural conviction from short-term excitement. Over-leveraging into spikes invites volatility-induced liquidation. Gradual accumulation during consolidation aligns better with long-term thesis. The thesis remains clear. Inflation pressure persists. Industrial transformation accelerates. Supply growth lags structural demand. Geopolitical fragmentation increases stockpiling behavior. Monetary policy operates under constraint. These drivers create an environment where silver thrives. Mining sector developments reinforce narrative. As prices strengthen, margins expand. Producers with stable cost structures generate cash flow. Exploration budgets rise cautiously. Investors evaluate jurisdictional stability and operational efficiency more critically. Capital allocation becomes strategic rather than speculative. Exchange-traded funds serve as bridge between financial markets and physical demand. Inflows translate into metal acquisition. Sustained inflows reduce available float. Meanwhile, retail interest resurges during volatility. Coin and bar demand often spikes when headlines reflect instability. Dealers adjust premiums accordingly. Replacement costs reflect tightening supply. These micro-level behaviors aggregate into macro-level shifts. Another often overlooked element is energy cost. Mining is energy-intensive. When energy prices remain elevated, production costs increase. Higher cost floors support higher equilibrium metal prices over time. This does not eliminate volatility, but it raises baseline support. The long-term outlook for both gold and silver remains constructive under prolonged uncertainty. However, silver's industrial integration adds additional layer of resilience. As technological infrastructure expands globally, silver demand scales alongside it. We must also consider generational shifts in investment philosophy. Younger investors exposed to digital assets and decentralized concepts often gravitate toward tangible alternatives when volatility strikes. Physical ownership provides psychological security. Digital records can be altered, paper contracts can default. Physical metal in allocated storage remains immutable. This perception strengthens during systemic stress. As vault inventories decline relative to demand, narrative intensifies. Scarcity captures attention. Attention attracts capital. Capital accelerates movement. But the ultimate driver remains imbalance between supply and demand. Imbalance sustained over time redefines price. Silver's recent behavior signals early stages of such redefinition, not because of a single catalyst, but because multiple pressures converge simultaneously. The world is recalibrating economic assumptions. Silver reflects that recalibration in real time. When vaults tighten and demand expands, markets do not whisper. They adjust with force. Silver's surge is not a fleeting headline, but a mirror reflecting deeper shifts in trust, supply, and global structure. Whether volatility brings temporary pullbacks or continued acceleration, the underlying message is clear. In an era of uncertainty, tangible scarcity commands attention. And as the system recalibrates, silver is no longer waiting quietly in the shadows. It is asserting its role at the center of the storm.